If you can make one wish to a genie, the kind where you only get one, you can't wish for multiple wishes, what would you choose? For me, one thing always comes to my mind, always. Going back in time and giving advice to my 10-year-old self. Like, buy Bitcoin while it's $300. Or make that investment. Stop trying to time the bottom. But you know what the problem with that is? We only see the bottom after it's passed. And those who wait too long are usually left with regret. I'm Chad with Zero Markets. And in this video, I want to show you why you don't need to hit the bottom or the top to make money in the market. It's simpler and more powerful than it seems. So we all have that one friend who says, if I'd only bought that stock back then, right? Or that other one who swears they'll invest as soon as the market drops a little bit more. The truth is, nobody consistently gets the timing perfect. Nobody, not even the big names. Warren Buffett doesn't buy at the bottom. Neither does Peter Lynch. What they do and what you can do is build a position over time based on value and a long-term view. The market moves in cycles. There's a time for euphoria, a time for a drop, and a time for recovery. But one thing is important. In the long run, the trend is up. Why? Because companies adapt. Technology advances, productivity increases, societies evolve. This doesn't mean everything only goes up, but rather that the world never stops reinventing itself. And those who invest with a vision for the future ride that wave. Investing is like building a house. You don't wait for bricks to be at their lowest price of the decade to start. You buy the materials, you build the foundation, put up the walls. Sometimes the cement is more expensive, sometimes it's cheaper, but what matters is finishing the job. And that is how you build wealth. One step at a time. There's a simple and powerful strategy called DCA, or dollar cost averaging. You invest every month regardless of the price. When it drops, you buy more. When it goes up, you buy less. And in the end, you'll be paying an average price and holding the asset. Now, imagine doing that with a stock that also pays dividends. Even if the price fluctuates, you continue to earn over time. And if you diversify across sectors and countries and strategies, you reduce the risk of being in the wrong place at the wrong time. It's not luck, it's method. I have a friend who spent months saying he was going to buy a certain stock, but he wanted to wait for it to drop another 10%. It dropped 5%, and he thought it would drop more. When it went up 15%, he gave up. Today, it has doubled, and he's still waiting for the right time. Another example, a colleague who started investing during the pandemic, buying good stocks consistently. Today, he doesn't even worry about the price. He focuses on growing his portfolio and accumulating wealth. Who do you think's better off? Every investor has an if-only story stored away. If I'd only started sooner, if I'd only sold during that drop, if only I'd had the courage to invest in that moment. But here's the key. If only appears for those who stayed on the sidelines, for those who let fear paralyze them. If you enter with strategy and vision, you trade the if only for peace of mind. The question you need to ask is not, is this the bottom? The question is, does this company or asset make sense for my portfolio in the long term? If the answer is yes, start, even if the price fluctuates afterwards. Because investing well isn't about guessing the market. It's about respecting a process. Investing is more like a marathon than a short sprint. You don't need to be in the lead from the start. You just need to stay on the path. And most importantly, stop waiting for the perfect scenario to act. If this content helped you, please leave a like, subscribe to the Zero Markets channel, and comment below, do you have an if only that you still carry today? Or have you learned to move forward with consistency?